How much super do you actually need to retire comfortably in Australia? Most people guess a number. Some say $500,000, some say $1 million, and some people have no idea at all. But here's the thing. The answer is not one simple number. It depends on your lifestyle. It depends on whether you own a home. It depends on whether you retire alone or as a couple. And it depends on when you want to retire. So in this video, I'm going to break it all down simply. By the end, you will know a realistic super target for your situation. You will understand what comfortable retirement actually means in Australia. And you will know what to do if you feel behind. Let's get into it. Part 2. What is superannuation? Before we talk numbers, let's quickly cover what super actually is, because a lot of younger Australians don't fully understand it yet. Superannuation is Australia's retirement savings system. Every time you work and get paid, your employer is required to contribute a percentage of your salary into your super fund. That money is invested on your behalf. It grows over time, and when you reach a certain age, you can access it to fund your retirement. The idea is simple. Build a large pool of money during your working life, then draw it down during retirement. Now the important point. Super is not just a savings account. It is an investment account. It is invested in assets like shares, property, and bonds. That means it grows through returns and compounding over time, which also means the earlier you start and the more you contribute, the bigger it grows. Part 3. This is where most conversations go wrong. People say they want a comfortable retirement, but what does that actually mean in dollar terms? In Australia, there's a well-known retirement benchmark. It is produced by the Association of Superannuation Funds of Australia. Most people call it ASFA. ASFA publishes what they call the retirement standard. This gives a rough guide to how much money you need each year in retirement. For a single person, a comfortable retirement income is estimated at around $50,000 to $55,000 per year. For a couple, it is estimated at around $70,000 to $75,000 per year. Now, what does comfortable include? It includes a reasonable standard of living. It includes occasional dining out. It includes domestic and some international travel. It includes private health insurance. It includes home maintenance. And it includes reasonable leisure activities. It does not include a luxury lifestyle. But it is more than just getting by. Important note. These figures change over time. Always check the current ASFA figures for the most up-to-date numbers. Part 4. Do you own your home? Here's something most people overlook. The ASFA retirement standard assumes you own your home outright by retirement. This is a big assumption, because if you own your home outright, you have no rent, you have no mortgage. Your biggest living expense is already covered. That means your super just needs to cover lifestyle spending. But if you do not own a home by retirement, you will need more super, because you will need to cover rent or housing costs on top of everything else. So when people ask, how much super do I need? The first question back should be, do you plan to own a home by the time you retire? If yes, the standard benchmarks apply. If no, you will need a larger super balance. Part 5. Now let's get to the number everyone is looking for. Again, this is a general guide, not a personal plan. And figures can change, so always check current benchmarks. For a single person who owns their home, to fund a comfortable retirement income of around $50,000 to $55,000 per year, a rough super balance of retirement of around $500,000 to $700,000 is often cited as a general guide. For a couple who owns their home, to fund a comfortable retirement income of around $70,000 to $75,000 per year, a rough super balance of around $600,000 to $800,000 combined is often used as a guide. Now, these are ballpark numbers. The exact amount depends on your age when you retire, how long you live, your investment returns inside super, whether you receive the age pension, and your actual spending habits. Part 6. Many Australians forget that the age pension exists. And for a lot of retirees, it plays a big role. The age pension is a government payment for eligible Australians who reach pension age. Currently, pension age in Australia is 67. But always check the current rules, because they can change. The age pension can top up your super income significantly. For some people, a smaller super balance plus the age pension can still fund a reasonable retirement, but the age pension alone is not enough for a comfortable retirement. It is more of a safety net. So the goal is, build enough super to fund your retirement comfortably. And if you are also eligible for some age pension, that is a bonus on top. Part 7. Now let's talk about whether you are on track, because the final super balance is only one part of the picture. You also need to think about where you should be right now, for your age. Again, these are broad ranges, not exact targets. In your 20s, A super balance of around $10,000 to $30,000 is common. Some people have more, some have less. The key is that contributions are happening. In your 30s, a super balance somewhere in the range of $50,000 to $150,000 is broadly typical, but this varies a lot, depending on career, salary, time out of the workforce, and contribution history. In your 40s, a super balance of around $150,000 to $350,000 starts to appear more commonly. This is where compounding really starts to work for you. In your 50s, a balance of around $250,000 to $500,000 or more starts to become important because retirement is getting closer. And this is the decade where extra contributions can make a real difference. In your 60s, this is where you want to be approaching your retirement target. The goal is to be close to that $500,000 to $700,000 range for a single person, or that combined $600,000 to $800,000 for a couple. Owning your home by this point matters a lot. Now, if those numbers feel far away, do not panic, because there are things you can do. Part 8. Here are the most practical things you can do to grow super faster. Number 1. Check your super fund fees. High fees quietly eat your balance over decades. Even a small difference in fees can add up to tens of thousands of dollars over time, so compare your fund. Make sure fees are reasonable. Number 2. Check your investment option inside super. Most people are placed in a default option, but depending on your age and timeline, you may want to review whether that option suits you. Someone in their 20s has a long time horizon. Someone in their 60s needs a different approach. Number 3. Consider making extra contributions. In Australia, there are two main types: concessional contributions. These are before tax contributions. They include employer contributions and salary sacrifice contributions. Non-concessional contributions. These are after tax contributions you make yourself. Extra contributions can significantly boost your balance, especially if you start earlier. But always check the current contribution limits because they apply each financial year. Number 4. Avoid withdrawing super early. Unless it is a genuine financial hardship situation, taking super early can significantly damage your retirement balance because you lose the compounding effect on that money. Number 5. Consolidate multiple super accounts. If you have worked multiple jobs, you may have more than one super account. Multiple accounts mean multiple sets of fees. Consolidating into one account reduces fees and keeps things simple. Part 9. If your super balance feels low right now, here's a simple perspective. Super is a long-term game. Small, consistent actions over time make a big difference. You do not need to fix it all overnight. Start with these steps. First, log into your super account. Check your balance. Check your fees. Check your investment option. Second, see if salary sacrifice is available through your employer. Even a small extra contribution each pay can add up significantly over years. Third, check if you are eligible for the government co-contribution. If you are a low to middle income earner and you make personal contributions, the government may also add to your super. Always check the current eligibility rules. Fourth, get financial advice if you need it. A licensed financial advisor can help you create a personalized super strategy. Part 10. So, how much super do you need to retire comfortably in Australia? As a broad guide, for a single person who owns their home, around $500,000 to $700,000 is a commonly used ballpark. For a couple who owns their home, around $600,000 to $800,000 combined. But remember, these are general guides, not personal targets. Your situation is unique. Your lifestyle goals matter. Your home ownership plans matter. And whether you may receive the age pension also matters. The best move is to understand your super now. Take small, consistent steps to grow it, and seek personal advice when you need it. If you found this video helpful, subscribe to Aussie Wealth Simplified. We make Australian finance simple and practical. And comment below, do you want the next video on how to choose the best super fund in Australia, or how much money you need to retire early in Australia? Let me know below. Thanks for watching.